I just moved 30% of my portfolio into cash. Not because I'm panicking, but because I'm seeing this signal, and I'll explain why in just a moment. But first, if you're worried about your financial future, you're absolutely right to be. And if you have money in the market, the next 12 minutes could help you protect your wealth before the biggest financial storm of the decade. Markets are at record highs. Unemployment is low. GDP is growing. But there are three signals that 99% of investors don't know about that are screaming danger. This is not normal. The first signal? The yield curve just inverted for the fourth time in history, and I'm going to show you the exact numbers. The inverted yield curve, when short-term bond rates exceed long-term rates, has predicted 100% of recessions since 1969. Not a single false signal. And last week, we witnessed the deepest inversion since 1981. This is what the Federal Reserve doesn't want you to know. This is why I rebalanced my portfolio. If you're worried about your financial future, you're absolutely right. But worry doesn't protect wealth. Preparation does. 10,000 people in our community are tracking these signals in real time. Sarah from Texas just reported she hit her 6-month emergency fund. Mike from California rebalanced and avoided a 15% loss. In the next 11 minutes, I'll show you the three things that are different this time from 1929 and 2008, and the 7 specific steps you can take this week to protect your wealth. You know what? Most people think the yield curve is some complicated thing only for Wall Street, but actually, it's the most powerful forecasting tool that anyone can understand. And I'll prove it with one simple number, 100%. That's the accuracy rate of the inverted yield curve in predicting recessions since 1969. Not a single false signal, not once. We've seen this before, but here's what 99% of investors don't know. The yield curve doesn't just predict a recession. It tells you exactly how long until it hits. The inverted yield curve sounds complicated, but it's actually simple. Imagine you're lending someone money. Normally, you'd charge more interest for a longer loan, right? 10 years should have higher rates than 2 years. But when the yield curve inverts, the opposite happens. Short-term rates are higher than long-term rates. What does this mean? And here's what 99% of investors miss. Pause. They only look at the numbers, but they ignore the timing. It means the market is panicking. They believe the future will be worse than the present. And history shows they're always right. Last week, the 2-year Treasury yield exceeded the 10-year for the first time since 2022. And this isn't the first time I've seen this signal. So, how do you track the yield curve? It's really simple. Step 1. Go to the FRED website, Federal Reserve Bank of St. Louis. It's free, real-time data. Step 2. Search for 10-year Treasury and 2-year Treasury. Step 3. When the 2-year is higher than the 10-year, that's when you need to pay attention. I check it once a week. Takes 2 minutes. And this is why I rebalanced my portfolio last week. And 3 new warning signals from last week's Fed meeting that make me believe we only have 6 to 12 months left. I'll reveal them at the end of this video. But the yield curve is only the first signal. There are 2 more signals I'm about to reveal right now. Now, I know what you're thinking. Hey, every crisis is the same. Why is this time different? This is the question I've been asking myself for the past 6 months. And after analysing 50 years of data, interviewing 12 experts, and testing strategies with my own portfolio, I've discovered 3 fundamental differences that no one is telling you about. In 2008, I lost 40% of my portfolio because I wasn't prepared. This time, I'm not making that mistake again. And difference number 3, it will determine whether you're someone who survives or someone who thrives. Difference has shown tools for the people. In 1929, people only had newspapers and radio. When the market collapsed, they found out 24 hours later. In 2008, there was the internet, but only Wall Street had real-time data. 2024, You have apps on your phone tracking your portfolio in real time. You have YouTube, Discord, Telegram to share information. You have AI to analyze data. For the first time in history, retail investors have the same tools as the professionals. Difference #2. Alternative assets. In 1929 and 2008, you only had stocks, bonds, and real estate. That's it. When everything collapsed together, you had nowhere to run. But 2024? Cryptocurrency, REITs, commodity funds, international markets, even NFTs. You have 50 ways to diversify that our grandparents never had. And difference number 3. This is the real game changer. Difference #3. Community preparation. In 1929 and 2008, people faced the crisis alone. There was no way to connect, share strategies, or learn from each other in real time. But right now, 10,000 people in our community are preparing together. Sarah from Texas just built her 6-month emergency fund. Mike from California rebalanced his portfolio last week. We're not alone. History doesn't repeat itself, but it rhymes. And this is why I believe that this time, those who prepare properly won't just survive, they'll thrive like never before. Comment below, have you rebalanced your portfolio yet? What's your current allocation? So how do you become one of them? The next 7 steps will show you exactly how. Now you understand why I took action. But knowledge without action is like watching your house burn down. This is why I spent the past 3 weeks completely redesigning my portfolio strategy. And I'm not just talking. These are the actual trades I made last week. $47,000 moved to cash, $23,000 into defensive positions, $15,000 into an opportunity fund. Why am I sharing real numbers? Because I want you to see this isn't theory. This is the strategy I'm betting my own money on. We just covered the warning signals. Now comes the most important part, the action plan. And in the next 4 minutes and 30 seconds, I'll walk you through exactly the 7 steps I took. Steps 1 and 2 you can do today. Steps 3 to 5 do this week. Steps 6 and 7 complete within 30 days. But before we start, there's one important thing you need to know. That important thing is this. This is not a sprint. This is a marathon. Sarah from Texas built her 6-month emergency fund in 45 days. Mike from California rebalanced his portfolio and only dropped 2% while the S&P fell 15%. Lisa from New York created a $2,400 month passive income stream in just 3 months. They're not financial experts. They just followed the system. And that system is these 7 steps. Step 1. Audit your emergency fund. Target 6 months of expenses. If you don't have it, open a high-yield savings account today. Marcus by Goldman Sachs, currently 4.5% APY. Ally Bank 4.25%. I'm using both. Step 2. Rebalance your portfolio. From 80 over 20 stocks, bonds to 60 over 40. Or if you're more conservative, 50 over 50. Sell high-growth stocks first. Keep stable dividend payers. Step 3. Prioritize debt elimination. High-interest debt first. Credit cards, personal loans. Mortgages last. Spreadsheet template in the description. Step 4. Diversify income streams. I'm testing 3 options. Dividend funds for passive income. Part-time consulting in my expertise. Online course about financial preparation. Step 5. Allocate to defensive assets. 10-15% of portfolio into recession-resistant sectors. Utilities, consumer staples, healthcare. VTI, XLP, XLU are the funds I'm holding. Step 6. Create an opportunity fund. 20% cash position to buy assets during the crash. Here's my shopping list. Quality stocks down 50%. REITs. Bitcoin under $20K. And Step 7. This is the real game changer. Step 7. Community accountability. This time won't be different. Here's what I learned after 15 years of investing. Preparing alone is a recipe for failure. You need accountability, you need support systems, you need community. 10,000 people in the Recession Prep Challenge are executing these 7 steps together. Weekly check-ins, shared progress tracking, real-time support when markets swing. So there you have it, the inverted yield curve, a 100% accurate signal for the past 50 years. The 3 differences this time that help you not just survive but thrive. And the 7 specific steps to transform worry into preparation. I can't predict exactly when this will happen, but preparation always beats prediction. And about those 3 new warning signs from the Fed meeting I mentioned. Number 1, the Fed quietly reversed 40% of repo operations in 2 weeks. Number 2, regional banks are hoarding cash at unprecedented levels. Number 3, Powell's language shifted from transitory to closely monitoring. The signs are clear. Now you understand why I'm saying we have 6 to 12 months left. If this video helped you see the situation clearly and gave you a concrete plan, hit that like button and subscribe so you don't miss the next critical analysis. Next week's video, I'll track live portfolio performance after 1 week of implementing these 7 steps, plus an exclusive interview with the economist who accurately predicted the 2008 crash. Preparation beats prediction. Take action today. Leave a comment about your biggest concern and I'll address it in the next video.